The reason you are still living in a property owned by someone else is not because the housing market is broken. It is because you are weak. You have spent your entire adult life waiting for the perfect moment, waiting for a market crash that will never happen to save you, and waiting for a 20% down payment that you are too undisciplined to save. You are watching the clock tick toward 2026, and you are terrified because you see the prices climbing while your wages stagnate. You blame the economy, you blame the government, and you blame the banks, but the reality is that you are simply a victim of your own ignorance. You are playing a game with rules from the 1980s while the elite are playing a game designed for the future. If you want to continue being a spectator, turn this off right now and go back to your mindless entertainment. But if you have the intellectual capacity to understand that your survival depends on your ability to leverage assets, then you need to pay attention. Subscribe to Wealth Radar right now. This is the only place where the truth is not filtered for your comfort. This is the only community that will give you the blueprint that the middle class is too scared to follow. If you are not subscribed to Wealth Radar, you are choosing to stay blind and broke. Number 1. The first tactic involves the strategic use of conventional 97 programs and the absolute destruction of the 20% down payment myth. Most of you have been brainwashed by your parents or by some low-level financial advisor who told you that you must have 20% down to avoid private mortgage insurance. This is the most expensive advice you will ever receive. While you spend 5 years trying to save up an extra 15%, the property value has likely increased by 20 or 30%. You are saving in a currency that is losing value to buy an asset that is gaining value. It is a mathematical trap designed to keep you in the rental cycle. In 2026, the gap between those who own and those who rent will widen into a canyon. By using a 3% or 5% down conventional loan, you are securing the asset at today's price. Yes, you will pay a small monthly fee for mortgage insurance, but that insurance is the cost of admission. It is a convenience fee for the bank, allowing you to control a $500,000 asset with a mere $25,000. Think about the return on investment. If a house goes up 5% in value in 1 year and you put 20% down, your cash-on-cash return is mediocre. But if you put 5% down and the house goes up 5%, you have essentially doubled your investment in 12 months. This is how wealth is manufactured. The poor focus on the monthly cost of insurance, the rich focus on the velocity of their capital and the total control of the asset. You need to stop looking at PMI as a penalty and start looking at it as a bridge to equity. In 2026, lenders will be even more aggressive with these low down payment options because they need the loan volume. You must be positioned with a credit score that reflects discipline, not a history of consumerist impulses. If your credit score is below 740, you have already failed the first test of adulthood, and you have no business even looking at a house until you fix your character. Number 2. House hacking through the FHA and multi-unit expansion is the only way for the average person to escape the rat race in 2026. You are too proud to live with roommates or tenants. You want the white picket fence and the quiet neighborhood immediately. This pride is why you are broke. A multi-unit property, specifically a duplex, triplex, or fourplex, is not just a home. It is an income-generating machine that happens to have a bed for you. In 2026, the FHA has streamlined the process for self-sufficiency tests, allowing you to buy up to 4 units with only 3.5 to 5% down. This means you can control 4 streams of income while only being responsible for a fraction of the debt yourself. The tenants are not your friends. They are your business partners who are paying off your mortgage and building your net worth while you sleep. When I started, I didn't care about the aesthetic of my living situation. I cared about the balance sheet. You are worried about the color of the kitchen cabinets, while I am worried about the debt coverage ratio. If you buy a 4-unit building in 2026 with 5% down, you are using the ultimate form of legal leverage. You are getting a residential interest rate on what is essentially a commercial enterprise. Most people are too lazy to handle the management of tenants. They find it stressful. Success is stressful. Poverty is also stressful. You must choose your stress. If you choose the stress of management, you end up with a paid-off asset and a lifetime of cash flow. If you choose the stress of being a tenant, you end up with nothing but a collection of rent receipts and a heart full of regret. You need to view your first home as a stepping stone, not a destination. If you aren't willing to live in one unit while 3 other people pay for your lifestyle, you don't actually want to be rich. You just want to look rich. Number 3. Leveraging seller concessions and interest rate buy-downs is a tactic that requires you to stop being a polite buyer and start being a predatory negotiator. In 2026, the market will have pockets of stagnation where sellers are desperate to move their inventory but are unwilling to drop their asking price because of their ego. You will use this ego against them. Instead of offering 5% less on the price, you offer the full asking price but demand that the seller contributes 3% of the purchase price toward your closing costs and a temporary interest rate buy-down. This is often called a 2-1 buy-down. This means that for the first year, your interest rate is 2% lower than the market rate, and for the second year, it is 1% lower. This preserves your liquidity at a time when cash is king. By putting 5% down and having the seller pay your closing costs, you walk into a house with almost no cash, out of pocket, compared to the traditional model. You are essentially getting the seller to fund your entry into the market. While everyone else is complaining about high rates, you are sitting on a subsidized rate for the first 24 months, giving you time for your income to grow or for the market to appreciate so you can refinance when the cycle turns. You must understand that the price of the house is irrelevant if the terms of the debt are favorable. Most buyers are obsessed with the sticker price because they are mathematically illiterate. The wealthy are obsessed with the terms. You need to find a realtor who isn't a part-time hobbyist, but a professional who understands how to structure a contract that forces the seller to solve your capital problem. If you are too shy to ask for these concessions, you deserve to pay the full price and stay poor. Number 4. Stacking down payment assistance and local grants is the tactic for those who are willing to do the boring work that no one else wants to do. You think you're too good for government programs. You think it's for people who are struggling. That is your ego talking again. There are billions of dollars in state and local funds earmarked for housing in 2026 that go unused every year because people are too lazy to fill out the paperwork or attend a 4-hour seminar. Many of these programs allow you to stack a 5% down payment from your own savings with a 2 or 3% grant or a silent second mortgage from a local housing authority. This can result in you entering a property with more equity than you actually paid for. This is essentially an immediate return on investment. You are being paid to buy a house. But this requires you to be proactive. You cannot wait for the bank to tell you about these programs. The bank wants you to take their most profitable product, not the one that is best for you. You must research every municipal, county, and state program available in your target area. You must understand the income limits and the debt-to-income requirements better than the loan officers themselves. If you aren't willing to spend 50 hours researching these programs to save $50,000, then your time is worthless and you deserve to stay in your current financial position. Wealth is not given. It is extracted through superior information and the willingness to execute on that information. The 2026 market will reward the diligent and punish the distracted. Number 5. The final tactic is the utilization of social capital and private leverage through co-borrowing or equity sharing. Most of you have family members or acquaintances who have capital sitting in a savings account earning a pathetic interest rate. They are losing money to inflation every single day. You represent an opportunity for them, provided you aren't a financial liability yourself. In 2026, you can structure a 5% down purchase where you provide the labor and the management, and a partner provides the capital or the credit backing. This isn't a handout, it is a business partnership. You can use a family gift for your 5% down payment, or you can have a non-occupant co-borrower to help you qualify for a much larger asset than your single income would allow. The wealthy do not use their own money for everything. They use other people's money. If you can prove that you have the discipline to manage an asset, people will give you money to control it. But if you spend your weekends drinking and your weekdays complaining, no one will trust you with a dime. You need to build a track record of reliability. You need to show that you understand the 2026 market dynamics. When you approach a potential partner, you shouldn't ask for help. You should offer them a way to hedge against inflation through a real estate partnership where you do all the heavy lifting and they share in the appreciation. This is how empires are built. You start with 5% of your own or someone else's money, you control 100% of the asset, and you repeat the process until you no longer have to work. You now have the 5 tactics. You have the blueprint for the 2026 housing market. But let's be honest, most of you will do absolutely nothing with this information. You will finish this video, close your laptop, and go back to your mediocre life. You will continue to pay rent to a landlord who followed these steps while you were busy making excuses. You will watch as property prices move further out of your reach, and you will spend the rest of your life wondering why you never caught a break. The break is here. The information is in front of you. The difference between the rich and the poor is not talent or luck. It is the courage to act on a strategy while everyone else is paralyzed by fear and consumerism. You have 2 choices today. You can ignore everything I just said, stay comfortable in your failure, and fade into the background of the struggling masses who will never own anything of value. Or you can commit to a different destiny. You can join the elite who are actually building something. If you want to stay on the path to wealth and avoid the trap of permanent tenancy, you will follow Wealth Radar and you will treat every word I say as the law of your financial survival. The choice is yours. Stay average and ignored, or join Wealth Radar and change your destiny. I don't care which one you pick, because my wealth is already secured. Decide now if yours will be